Oil prices are surging, stock markets and bond markets are responding to this, and inflation and interest rates are being called massively back into question. So here are the three major things that you need to know from the stock markets last week that could affect you, your money and your investments. Hello and welcome back. My name's Zoë Burt from Words on Wealth, and it's a pleasure to have you here on my channel. I'll be doing one of these market updates every single week on a Monday for you, as well as another video on Friday as well. Let's dive in. First things first, a lot of the talk off the back of last week and into this week is about oil prices. Now, just as a recap, conflict escalated in the Middle East last week after attacks from the US and Israel into Iran. What this meant is that Iran, who is a major exporter of oil and LNG gas to the rest of the world, retaliated and also started attacking other major nations around and close by. What this led to is essentially conflict escalation, but also greater fears around the supply of oil. This was only elevated by the fact that Iran controls what is known as the Strait of Hormuz. And the Strait of Hormuz has an estimated 20% of the world's global oil pass through it. They threatened to close it, the US said that they'd protect it. In reality, it doesn't really matter which it is for the moment, because a lot of what is going on with oil prices, with then the eventual stock market reaction, is just based on fear of what's to come. And the fear is that 20% of the global oil supply being restricted, it's not great for prices. And as a result, what we've seen over the weekend is that oil prices have shot up to highs not seen in some places since last October 2024, and in some cases not seen since COVID 2020. And what this means is that oil has surged beyond around the $100 a barrel mark, which is also quite a psychological mark. It's potentially seen as a bit of a threshold of then quite expensive oil, and this has loads of other knock-on impacts too. First and foremost, one of the biggest impacts is that oil underpins so much of what we do. And as a result, when oil prices go up, we tend to see increased inflation. And this is exactly what we saw 2 or 3 years ago, back in 2022, when the invasion of Ukraine caused oil prices to spike. And the knock-on impact across the globe was inflation levels that went beyond 10% in many places, despite the 2% target that most governments have. We're only just really at a point where inflation has come back down to more or less what governments want it to be. So with this increased escalation in conflict, again, we've actually seen some major oil refineries being hit over the weekend by strikes and increased fear. All of this could push inflation up once again. And that will hit our pockets as consumers. We may well see that prices at the pump will get more expensive when we're putting oil into our cars. But we might also see the prices of food and other goods that we're buying as well also become more expensive, because that's what happens when oil prices go up, and it's what happens when we see increased inflation. When it comes to stock markets, there are always winners and losers from oil prices going up and increased inflation. Into the latter end of last week and into the beginning of this week, we've already seen some major oil companies see their share prices increase. I'm talking the likes of Shell and BP. We've also seen some safe haven assets, or some so-called safe haven assets, like gold, the US dollar, and others that investors flock to in bad times, increase in value. On the flip side, there are always losers. So those that are very intensive in terms of how much oil they need, I'm thinking the likes of engineering, automobiles, tend to see a bit of a downturn, which indeed they have, as do others like the travel industry, which is currently suffering from this increased tension and the closure of many major airport hubs in the Middle East. Which brings me on to the second thing that we need to talk about from last week's stock markets, which is the stock market reaction to all of this increased conflict. Generally, stock markets have responded pretty negatively to this increased conflict. And as we moved into the latter part of the week and it became clear that it was not going to end super quickly, that a potential next Iranian leader was not going to be the one that Donald Trump wanted, and that in fact there was a lot of retaliation taking place, which could mean even more heightened conflict, the stock markets retreated even further. Markets like the UK, which is a net importer of oil, further face more pain when it comes to this sort of conflict, because we're not an exporter of oil, we in fact depend upon it. And so the fear around our own economy and potential impact on the stock market too is much greater, because those price changes could well impact us further. This meant that by the end of the week, a lot of the gains that European and British markets had made this year had been chipped away at the very least, by this increased conflict and the potential fear of what could come. It's worth also touching upon bond yields, because the bond market in size, believe it or not, is actually bigger than the stock market, but it's not one that you and I necessarily engage in quite the same way. Now, bond yields, which is how much they pay, and bond prices, which is how much you can buy them for on the secondary market, move in opposite directions. So normally, when bond prices are coming down, bond yields are going up. Because what that means is that basically governments who provide these bonds are having to pay more in the form of yields to attract investors to bonds, and their prices go down because investors no longer want to hold them. Of course, it works in the opposite direction too, but what at the moment we're seeing is that yields are going up and prices are coming down because there's a greater level of uncertainty within the world. Now, what this can impact is first and foremost government borrowing, particularly when we're talking about government bonds. Because if they have to pay more to be able to borrow through bonds, that's not great for their levels of debt, which is something that is being increasingly talked about post-COVID-19 pandemic and as governments have greater levels of debt generally. What it can also mean is that our pensions, which are often heavily invested into bonds, could well suffer. It's not something that we necessarily need to change direction on or really panic about, but it's something that we can have in our minds if we are looking at a broader portfolio of performance and how it is also doing. And last but not least, the third thing that you need to be aware of from last week is the talk around interest rates. Now, just to recap, because it all nicely flows together, these 3 points. Generally, when inflation increases, what central banks will do is they'll use interest rates to control that inflation, and they'll push interest rates up. Now, that has two main effects. First and foremost, anybody paying a loan that has a rate of interest on it, such as a mortgage, will see that loan value go up. Equally, if you've got cash in the bank that is paying a rate of interest on it, the amount that you earn on that cash in the bank will also increase. Now, this has one main effect, which is that people don't or can't spend as much. And so, with less circulation of money in the economy, hopefully inflation comes back down. As with anything, there are always winners and losers. So if you're somebody that has a loan or a mortgage that's on a variable rate and interest rates go up, it's going to get more expensive, and that can be tough. Equally, if you're someone with cash savings, any cash savings, which most of us will have in some way, shape or form, will get better. And so it's a nice little boost for people to at least see that increase. Now, in the wake of the 2022 invasion of Ukraine, we saw inflation go up and interest rates equally came up in the vast majority of countries to control inflation levels. Now, over the last year or so, we've seen interest rates come back down again, which is seen also as a move towards stimulating the economy and getting people spending and getting them moving again. What this now increased tension almost definitely means is that central banks will be taking a real pause on changing interest rates. They're not likely to keep coming down whilst this is going on and oil prices are going up, and inflation will potentially go up as well. And what we may also see is that they actually start to come back up again if this is a more prolonged period of conflict and inflation. So from a property perspective, that's not great news. Often what we see is that property markets are impacted by those changing interest rates, and increasing interest rates is rarely good for property investors. We might see on the flip side, financial services sectors, so the likes of big banks, really see a bit of a benefit from this. If interest rates go up, they earn more, and that is generally seen as quite good news. We might also see some other industries ebb and flow off the back of these potential inflation interest rate correlations, how they interact, and what that means for their overall business growth model too. So there you have it, the three main things that you need to look out for from last week's major market